Hi there. Yeah, this is day 3 of 7-day challenge, and as you can see, heavy losses so far. That's probably because there was a bit of manipulation earlier, prior to the interest rate announcement. So traders trying to force the price down because they have an inkling of what's going to go on. Um, okay, we'll just keep an eye on this and see what happens. I'd expect that prices would rise. So far, it's not going according to plan, but we'll see. That's a bit of my trade history today. Just £3 so far. Today is the 3rd of April, so 304 2014, as you can see there on the screen. And that was a bit of a safe exit yesterday, which was wise before my losses became too heavy and to give me enough equity essentially to enter another trade. Right now, there's nothing I can do if this goes against me, but I'm pretty confident that rates will be rising soon. Because the reason for this is when Mario Draghi, president of the not European Union now, something to do with the monetary fund in Europe, made an announcement today that interest rates will be kept on hold. And the implication meaning that the economy of Europe is still unstable. There's still fears that Europe might go into recession. So it follows that people are more likely to buy gold because of the uncertainty. Okay, so we'll keep an eye on this and see what happens. I will pause this video for now and continue later. Okay, we're back recording. I know it doesn't seem like that because all I did was pause the video. Draghi speaking at the moment, this European Commissioner, and you can see how the gold market is reacting. It went down. If you rewind a bit, you'll see that my last recording before the pause was around that region, and it dropped to that low, went up, dropped again to that low. That was after the information came out that interest rates were going to be kept on hold. But when the man starts speaking, that's what happens in the market, even though the information has come through. So, that's a power of the market essentially. As it is now, I have a very slim chance of making money out of this. We'll see what happens. Reason is my margin level is 55% at the moment, and my equity, of course, is less than $40 at the moment. So any violent downward swing would wipe me out essentially. But I'm still holding out. I'm still there, and I think that the market will recover eventually, with or without me. Obviously, it will recover. But I'm hoping there's a slim chance that I would get out of this one, because if there's uncertainty in the market anywhere in the world, especially the major economies, Europe and America, this is what happens. People tend to buy more gold, and so far, that's what's happening. The markets are picking up. Draghi is still speaking. Obviously, my TV volume has been reduced, but yeah. So as you can see, that's Draghi. If you can hear that, quantitative easing is one tool available, he says. Okay, so we'll see how this pans out, and we'll if I survive this, there'll be day 4 tomorrow. You see, this is live. I'm not playing any tricks here. I can't manipulate the markets. Some people do, but as long as you trade fair, observe the rules, You know, don't take risks, don't overtrade. Use as many tools as you can. I don't use many, but it's up to you as an individual. You decide what you want to do. Um, I'm keeping an eye on this. And like I said, there's a slim chance that I'll get out of this unscathed. Very slim chance. Even though the markets will recover eventually, will they recover after wiping me out or before? Yeah, that's a question. Okay, not recommended for you to trade with anything under $1,000 really. I started this trade with 100. It went down to 69, and that's when my 7-day challenge started. Okay, I'm gonna pause this for a few minutes, and I'll resume if there's any significant change. I'm just decided to carry on with the recording. I may not be speaking all the time. You can watch the movement of the markets. Drag is still speaking. People asking questions, journalists and experts in the industry. Okay, so I'll leave that running for a while and leave my TV volume on so you can hear the questions as well and look at the movements as they happen. So that's Drag is speaking.
We didn't discuss QE explicitly, and this explains why we discussed it this month. It's quite obvious that the Governing Council is looking at this prolonged period of low inflation. And it's quite obvious that the longer is, as I said, I think I did say this several times, the longer is the period of low inflation, the higher is the risk for inflation expectations in the medium and the long term. That's why we discussed, and that's the reason for this statement here. But let me also add one other consideration that applies also to the question that was asked me before by Brian a moment ago. If you take the rate of inflation of the first quarter of 2012 was 2.7%. Now it's 0.5. Of these 2.2 percentage points of difference, 70% of this is due to lower energy prices and lower food prices. So when we consider this, you are in a situation where at the same time one is concerned because this is a low inflation which has some drawbacks, also some positive things in the sense that supports real disposable income, especially of those people who have a fixed nominal income. And at the same time, this is being caused by exogenous factors. In fact, if you see what is the inflation rate in other countries, take the United States, where they are way more advanced in their recovery than we are, take Sweden, you see that the low inflation contains a high percentage of global factors.
Jack Ewing, New York Times. Two questions. One is, I wonder if you could just elaborate on what are the risks of low inflation, not deflation, but low inflation, for example, on debtors in the Eurozone. How big a risk is that in the view of the Governing Council? And the second question is, if you did decide to do QE, maybe you could tell us a little bit about how that would be designed in the context of the Eurozone, given the structure of the bond market and so forth. Thank you very much.
Thank you. On the second question is something that we will be reflecting hard and thinking hard. It is a question about how to design the QE, considering that our institutional and financial setup is considerably different from what it is in the United States, for example. In the United States, the effect of a kind of QE is immediate on all the asset prices, and the effect on the term premium is also quite direct. In because it's an economy based on capital markets. In our case, it's an economy based on the bank lending channel, and therefore the effect has to be carefully. I mean, the program has to be carefully designed in order to take this element into account. This is on the other point, the period of low inflation, a long period of low inflation. First and foremost, as I said before, the longer is the period of low inflation, the higher is the risk for the medium-term inflation expectations, which at the present time are firmly anchored, and also in our view of the medium term, they represent the anchor towards which inflation will gradually pick up and will converge in the medium term. The second drawback of a low inflation, especially in an area like the euro area, is that it makes the adjustment of imbalances much more difficult. One thing is to have to adjust relative prices with an inflation rate which is around 2%. Another thing is to adjust relative prices with an inflation rate which is around 0.5%. That means that certain prices, in order to readjust this, will have to become negative. In other words, their change will have to become negative. And you know that prices and wages have a certain nominal rigidity, which makes these adjustments more complex. The third point, the third drawback, has to do with debt, with the presence of a debt level which is both for private and public sectors still high, elevated. And with low inflation, the real value of this debt doesn't go down as fast as it would if inflation were higher. So it makes the adjustment, the deleveraging, the adjustment of the debtors more difficult. Also, you want to have, there's also a precautionary consideration here. You want to have an inflation rate which is, as I said, close to 2 but below 2%, because you may have, and this is exactly what happened in Japan, you may actually have, you may think you have a non-zero inflation rate, positive inflation rate, while as a matter of fact, you are already in a deflationary situation. So for measurement reasons, also, one would have to prefer an inflation rate which is close but below 2%. As I said, we don't see these risks now in Europe. In the euro area, I've said several times that I've listed several times the differences between our situation and the situation in Japan in the 90s and the early 2000s, which, however, doesn't mean that the Governing Council should remain unconcerned. So that's the reason, and I here add something to the previous question, that's the reason for having such a wide and rich discussion today.
Okay, I'm going to pause this here now. Okay, so there's been a bit of recovery in the markets, and I am now in pretty much safe territory, over 100%. That doesn't mean I'm out of the woods yet, but so far so good. The implication of having a margin level of over 100% means that I can close this trade now, which means that my loss would be just under $90. The advantage of that is that I can now get into another trade when the conditions are right. Okay, but what I will do with this trade is I will sit tight and see what happens. I know it's risky, but I will sit tight and see what happens, because I think that prices will still rise over the course of the day. They've been rising since Draghi finished speaking, so people are buying gold. People are nervous, but it looks like more investors are coming into the market to buy. Okay, it's going down now. It's probably going to go under 100%, which means that if I close that sale now, I won't be able to come back into the trade without putting more money inside, without paying more money into my account. Okay, the New York Stock Exchange opened 7 minutes ago at 2:30 UK time. So hence, I guess increased activity. Draghi has finished speaking. So relatively speaking, things have quietened down a bit. So people are taking the information in and acting on what's happening in the markets. Right, I will pause this video and possibly come back when it hits 1290. If it does today, I know it's going in the opposite direction right now, but I'll come back about 3 o'clock. It's 14:38 now, 22 minutes to 3. So about 3 o'clock when there's an activity that goes on in London at 3 o'clock. The gold price is set at 10:30 in the morning and at 3 o'clock in London. So that tends to have an effect on the market as well. Okay, so I'll see you between 3 and 3:15. So I'm just going to pause this again. And that would be the final section of my recording for today. So whether I make money or I don't, that will be my final recording. Okay, see you soon. Okay, final recording session for today. There's a bit of a slump and it's recovering again, so it means I'm making my money pretty much every second. Yeah, that sounds good, doesn't it? No matter how little it is. Anyway, yeah, gold prices are surging again. I stand a better chance now than I did a couple of hours ago of not losing everything. Okay, so I'm gonna leave this running now. That's a big surge. That is a big surge. I am very positive. That's usually an indication of the direction that things are gonna go or end up at the end of the day. You see that the price, there's been a bit of a resistance at that point for a while. Let's see, I expect that to happen now, but not for long. Once it gets to that price, there's a slight resistance right now. I would expect another resistance around there over the next few minutes, and then hopefully once that resistance line is breached, then things tend to go to move rapidly. I'm back at 100%, so safety, well, just under. But like I said, I'm not going to close the trade. I'd rather lose everything at this point, to be honest, but I don't think that's going to happen. Okay, my take profit is rather, it might seem ridiculous, 13.11. The reason being, I'll show you. The reason being is this is a trade which I intend to leave for a few days. I don't want to be drawn into the temptation, or I don't want to be tempted to overtrade. Overtrade, my definition would be more than 2-3 trades a day. Some of the experts suggest that you should trade at the barest minimum or barest maximum once a day. I trade whenever I see a big movement in the market. So if there's a movement today, there are 2 or 3 movements today, I would go in. Usually the very big movements happen maybe once or twice, once every week or once every 2 weeks, you know. Sometimes it does happen twice a week, sometimes even 3 times. That's really rare. Okay, so yeah, I am taking advantage of the announcement today, and also the busiest periods of the day, usually around 3 o'clock. The New York Stock Exchange opens at 2:30. So between 2:30 and 5, when the Bank of England, the London Stock Exchange closes, there tends to be a lot of activity in the markets. Right, so we'll sit tight on this one. I'll see you tomorrow in the next video. That would be day 4. Yeah, day 4 of our 7-day challenge. If you remember, my target initially was 5% a day over the next 7 days, and I did a calculation, if you remember, how much it would be, and then I revised that up to 7%, because at the time I was up It was ridiculous yesterday. But see, the reason why I've pegged it at 7% is that some days you'd have very good trades, and some days very, very bad trades. Okay. Okay, I'll see you on the next video. I'll see you tomorrow.